Hello, everyone. I just have to. There we go. I think I'm live on both Facebook and YouTube. Yep, it sure does look like it. I hope everyone has had a great summer and is ready for fall. I know I'm begrudgingly ready for fall. It's actually one of my favorite seasons. It's just up here in the Northeast, it lets you remind you that winter's coming. So, I wanted to welcome everyone to our live session on tax planning and preparation for small businesses. I'm Katie Brelsford, the president and CEO of KB Accounting, and I'll be guiding you through some key strategies to not only keep your business compliant, but also financially healthy. Whether you're just starting out or looking to refine your existing tax strategies, this session is for you. So let's dive in. First off, let's talk about the basics. Understanding your tax obligations is crucial. For every small business must comply with federal, state, and sometimes local tax regulations. We'll cover some different types of taxes you might encounter, like income tax, self-employment tax, things like that. So, income tax. Income tax, there's federal and state income tax. Businesses are required to pay on your profits at both the federal and state levels. The exact rates and requirements can vary depending upon the type of entity. So, like if you're a C Corp, an S Corp, a partnership, an LLC, a sole proprietorship, we're going to just talk about the corporations right now. So, a C Corp is taxed separately from their owners. They pay corporate income tax on their earnings, and then shareholders also pay personal income tax on any dividends, leading to double taxation. S Corps and LLC are considered pass-through entities. These entities pass the profits or losses to their owners, who report them on their personal tax returns. The business itself is not taxed at the corporate level, which helps avoid the double taxation of C Corps. Now, S Corps and LLCs are also different. Like S Corps have to file their own taxes. LLCs is just the taxes for the LLC and for the net profit are all a part of the owner's taxes. Small businesses often need to make estimated quarterly tax payments to the IRS to avoid penalties based on your expected actual income. Now, there's also a thing called self-employment tax. This is applicable to sole proprietors, partnerships, and LLC members, and it covers Social Security and Medicare obligations for the business owners. As you do not have an employer that withholds these taxes, the business has to be paid quarterly, and it's called self-employment tax. So for 2023, the self-employment tax rate was 15.3%, which is 12.4% for Social Security and 2.9% for Medicare. Owners can deduct the employer equivalent portion of the tax as an adjustment to income, which reduces their taxable income. Business owners must also calculate and pay self-employment taxes quarterly in addition to your regular income tax. So in the first section, I said you should pay quarterly estimated tax payments. In this, you need to pay based on what's actually happened for Social Security and Medicare. Now, there's payroll tax. So there's an employee withholding tax. Sorry, I had a smudge on my glasses, and it makes it hard for me to concentrate. I'm one of those people that has to have very clean glasses. So payroll taxes. There's employee withholding. When a business has employees, it must withhold federal and state income tax from their paychecks. This includes the employee share of Social Security and Medicare, or FICA. Employers also have to contribute to Social Security and Medicare on behalf of the employees and has to pay state and federal unemployment taxes. And your state may also have other payroll taxes that you have to pay. In Massachusetts, there's like this mass health fee that you have to pay. There's Fuda Suda, Mass Health, and there's one other. And it's right out of my grasp. I'll think of it. Businesses need to file payroll tax forms like Form 941 quarterly and deposit withheld and employer or portion of payroll taxes on a timely schedule. And that depends upon your total tax liability. Not everybody's on the same payroll tax schedule. There's penalties if you're non-compliant with your payroll tax. So it's very, very heavily scrutinized, and failure to remit taxes can lead to steep fines and even personal liabilities for business owners or executives. Another type of tax is sales tax. There's state and local sales tax. Many states and municipalities require businesses to collect sales tax on goods and services sold to customers. This tax is collected from the buyer at the point of sale and must be remitted to the state or local tax authority. A business must have a significant presence or a nexus in a state to be required to collect sales tax. For e-commerce companies, the definition of nexus has broadened following the Supreme Court decision in the South Dakota versus Wayfair in 2018. That allowed states to tax remote sellers based on economic activity, even without a physical presence. Businesses must file regular sales tax returns, which can range from monthly to annually, depending upon the volume of sales in particular jurisdiction. I know for us locally, we have to file monthly. No, I think I do have some clients that are on quarterly sales tax. So another form of tax is property tax. If a business owns real estate, it is subject to property tax based on the assessed value of the land in the building. These taxes are typically imposed by local governments such as cities or counties or municipalities. Some states and localities also tax business-owned tangible personal property such as machinery, equipment, furniture, and fixtures. Businesses must report the value of those assets annually. Number 6 is excise tax. Excise tax are imposed on specific goods and activities such as fuel, tobacco, alcohol, and environmental pollutants. For businesses involved in manufacturing, distributing, or retailing these products, excise tax compliance is crucial. Examples include the federal excise tax on gasoline or airline tickets, where the business is responsible for collecting and remitting the tax. Some businesses may have what's called a franchise tax. It's a state-imposed tax on a franchise. So some states like Delaware and California levy a franchise tax on businesses for the privilege of operating within the state. This is usually a fixed amount or a percentage based on the company's net worth, gross receipts, or paid in capital rather than on income. Franchise taxes are owed regardless of whether the business is profitable, which can be an additional financial burden on new or struggling companies. Finally, value-added tax. While the U.S. does not have a federal VAT system, businesses operating internationally or in countries with VAT systems must be mindful of these taxes. VAT is collected at each stage of production and distribution, ultimately passed on to the end consumer. If a business sells products or services across the borders, VAT registration and compliance in the destination country are required. So each type of tax adds layer of complexity to business operations. And as you've experienced, proper planning, regular compliance checks, and timely filing are crucial to avoiding penalties. Small businesses often struggle with the variety and volume of taxes, but with the right systems and guidance, they can maintain compliance while optimizing their tax liabilities. So next, we're going to go on to the importance of record keeping. And I cannot overstate how important this is. Accurate records not only ensure that you can claim all your entitled deductions, but it also protects you in the event of an audit. We'll go over some tips on how you can effectively track your expenses and income throughout the year. Effectively tracking expenses and income is fundamental for any business to maintain financial health, ensure compliance, and optimize performance. With over 13 years of experiences working with small businesses, I understand that having strong processes in place can prevent costly errors and provide sorry, my mouth's running too fast, provide clear visibility into a company's financial standing. So here's some practical tips on how you as a small business can stay on top of tracking income and expenses throughout the year. Choosing the right software is so key. Opt for an accounting software that fits your size and your industry. There's QuickBooks, Xero, FreshBooks, or Wave. They're all popular choices for small businesses, and these platforms can also help automate some of the data entry, categorizing expenses, and generate reports for you, reducing a lot of the manual workload you would have if you just did it in Excel. Ensuring the software you choose is scalable and integrates well with other systems that you might be using or might end up needing to using, like a point of sale system, a payroll, or inventory management softwares. You can also, with many of these softwares, link your bank accounts and your credit cards to the software so it automatically imports the transactions, and that'll save time and minimize the risk of missing or misclassifying expenses. But I have to add a note to this. I can't tell you how many times you can't rely on what we call the bank feed, because you have to, the software talks to the bank every night and takes the day before's transaction or whenever you ask it to look. But it will only go up to the day before. It won't do this current business day. But sometimes there's these transactions that are like in between that get missed. So you have to reconcile your bank account. And that is such a big word for such a small thing, because I will bet that the majority of us do this in our personal lives and don't even know that's what it's called. Do you log into your bank frequently, like, daily, weekly, monthly? Look at the transactions that happen just to make sure they align with what you used? That's a reconciliation. That's exactly what you're doing. You're taking your bank statement each month and you're comparing it to the transactions you have recorded into your accounting software. And you guys have got me going down a tangent here. Sorry. So anyway, the bank and credit card feeds help immensely getting the majority of your transactions. Just make sure you reconcile at the end of the month to make sure none were missed. So number 2, establish a consistent categorization system. This is important. You need to set up predefined categories that align with your chart of accounts. Some might include like office supplies, utilities, payroll, rent, marketing, travel, things like that. It allows for uniformity when recording transactions, and it simplifies the reporting. For more detailed tracking, use subcategories. So like under marketing, you might have digital advertising, print advertising, and events. And you can pull a report that only pulls the marketing line. But if you were wanting to know how much you spent in digital advertising, it would be easy to see if you expanded it a little bit. It helps you as you're trying to evaluate what's working and what's not. Frequently review your expenses categorizations to ensure that they're being applied consistently. Misclassifications can lead to inaccurate reporting and skewed financial analysis. And it also can cause problems when you go to do your taxes. So 3, establish a system for receipts and invoices. Encourage or require that all receipts, invoices, and bills be captured electronically. Apps like Expensify, Dext, or even the mobile apps of your accounting software can help with this. You can scan or take photos of the receipt and then which will then get automatically categorized and stored if you've set up the correct rules. Set up a process where employees or business owners submit receipts immediately after a transaction, so nothing is lost. So if you go to the store and you buy some Windex to clean your office windows, before you leave your car, you take a picture of that receipt. That's all you got to do. It's not hard. It's just setting up the practice. Store and organize vendor receipts in your accounting system. Many platforms allow for the entry of bills, tracking of due dates, and scheduling payments to ensure timely settlement and proper expense recording. Now we're going to my tangent. Reconcile accounts monthly. At the end of every month, reconcile your bank and credit card statements with your accounting records. Also do that for any loans that you have outstanding. It'll ensure that all your transactions have been recorded and that any discrepancies like missing payments or duplicates are caught early. Even if your software is automating many of the transactions, it's extremely important to review these reconciliations for errors that technology might not catch. Number 5, track cash flow proactively. Track your cash inflows and outflows with a cash flow statement, which reflects actual cash moving in and out of your business. This is essential for businesses that may experience cash shortages even when they are profitable on paper. Now, I want to caveat this because when an accountant says a cash flow statement, they are typically thinking of the financial report that would come out of your accounting software. For purposes of cash flow, weekly, daily monitoring of your cash flow, I don't recommend that. A lot of that statement uses terminology that is not going to be easily understood by a user, and it's not really gonna help you with projecting what you need within the coming month. So if you do it monthly, then you're going to want to use something similar to like a check register. When some of us older business owners were younger, we used to have checkbooks with check registers. And some still use them. I shouldn't say that they don't still use them today, because some do, where you would track every payment and then you would check it off at the end of the month saying that it cleared the bank. So you're going to need something similar to that. I personally use Excel or Google Sheets, and I show deposits for every day, checks written, debit card usage, payroll, and then the ending balance. And then I have a part where I reconcile that to the bank, where I put the bank balance, and then it has outstanding checks. And then you put in any checks that have cleared, so you get the outstanding checks for the end of that day. And then that total should match the total in the first section. You don't have to be that complicated, but what that helps me do is project it down. So I have a couple years worth actually of projections to say, this is all that I've got coming in. These are the things that I have to put out. And I can see forward if there's going to be a hiccup or something along the lines. And I do reconcile that daily to the bank, and I do it for many of our clients. I can't state how important that tool is, because every business I've ever worked with has a cash flow slowdown period in their cycle of business throughout the year. And it's important to have that period planned out ahead of time. So using a method like this allows you to be able to plan ahead and say, okay, I know that May is going to be our slow period because all the bills from the summer will be paid off and the new season hasn't started yet. So every month I should put a couple $1,000s and leave it in the bank to make sure I have enough money to make payroll for that period, or whatever your fixed costs are that you have to pay. Number 6, create a budget and use variance analysis. Those are big words, and I hate using words like that because it doesn't make sense to a lot of people. All that means is have a plan on where your money is going to go for the year and double check it. Weekly, monthly, quarterly, however you need to, and update it so that you can change your projections as the year goes on so that it matches what's really happening. Number 7, this is one that I will scream from the rooftop to anybody that'll ever listen to me, and nobody ever does. Maintain a separate business bank account. Stop using your same checking account for business and personal, because all that's going to cause is problems. When you need to go file your taxes or whatever, if you have it commingled, it's going to cause issues. So keeping a separate bank account for your business is essential, and it prevents tax issues, confusion, even legal liability concerns. Use a dedicated credit card, the same thing. I don't care if it's your personal credit card, but you only use it for business expense. You never use it for personal expense. Number 8, monitor accounts receivable and payable. This goes back with cash flow. Monitor your accounts receivable to ensure that customers are paying on time. Unpaid invoices can lead to cash flow issues, so set up reminders and follow-ups for late payments. And if you're using one of the softwares that we mentioned earlier, you can set it up. Like I use QuickBooks Online, and my QuickBooks Online is set up so that every month it sends out the bill to our clients, and then a couple days before the due date, it sends a reminder that the bill is going to be due. And then a couple days after the due date, it sends a reminder that you missed paying it. And then it'll send it again every month until it's paid. That keeps me from having to think about it and remember it. I'm always going in and seeing who's still outstanding, but it allows for a flow that happen that's not interrupted by my busy workday. Consider offering early payment discounts to incentivize timely payments, or using tools like invoicing software that sends automatic reminders. Like I said, my software also adds, so in my contract, it says that if it's a 1% per month interest late fee, not interest payment, late fee, and my system automatically adds that too. Keep a close eye on your bills and manage them to maintain strong relationships with your vendors while ensuring you don't overextend your cash reserves. Prioritize payments to avoid late fees and maintain a healthy credit standing. So finally, schedule a review of your financial statements with a CPA or a tax accountant at least quarterly so that they can help you spot issues and optimize your tax strategy and offer insights into improving your financial performance. By tracking income and expenses consistently and reviewing financials with a professional, you can avoid a last-minute scramble during tax season. It also ensures that you're taking advantage of tax deductions and credits throughout the year. So I'm actually running out of time today, so I'm not going to be able to go on to maximizing deductions. I'm going to have to close it out here. I have a meeting that I have to leave for strictly at 2:30. So I will have Alex make sure she includes some of this in the mailing, the newsletter that goes out. And that way you guys can get the benefits of this knowledge, even though I've run out of time because I squirreled too many times. I know, shocker. I hope you all have a great day. And as always, please like, share, comment this video. And if you know somebody who needs help, tag them in this video or share the video with them. Let's spread the word and help as many people as we can. And if you need help and you don't have a team that can help you, reach out to us and we'll see how we can help. I hope you all have a wonderful week, and I will see you next week.